Hello and welcome to On the Couch with Steve, a podcast where we help you navigate the often complex world of buying and selling real estate. Obviously, I'm Steve Athanates. I'm the owner of NG Real Estate here in Ipswich. We've got a very familiar guest with us. We've got Steve Beach from Stanford Financial. And for today's podcast, what we wanted to do was something really topical and hopefully something that will help you out. And it's really about how you get financially fit. All right? And that fitness relates to your ability to be able to finance or refinance in today's current climate. Everyone's talking about the cost of living, Steve. So obviously everyone's looking at how they can potentially either save money, either renegotiate loans to obviously try and eliminate some of the pressure. So first and foremost, welcome.
Thank you very much.
Good
to be back.
Yeah, good to see you, mate. Now, so when we're talking about financially fit, let's start off there. Let's explain to our viewers, what does it mean to be financially fit in order to be able to either get a loan or refinance an existing loan that you have? What sort of things can people be doing?
I guess what we're seeing in today's market and environment is a similar sort of question that a lot of people ask us is, when is a good time to actually reach out to a broker or to your bank to find out, what steps do I need to take to be able to get a home loan or refinance their home loans and everything along those lines. So a big thing that I guess financially fit is identifying your expenditure. So like we sort of said, cost of living, as we're all probably feeling the pinch, particularly with fuel prices and fuel excesses that are coming out in effect, like Uber and bits and pieces are now charging a little bit more because there's a fuel subsidy on there. I guess curbing some of that expenditure. So one thing that brokers and banks will look at is essentially your bank statements and your consumer spending. So I guess there is a calculation which was designed by the University of Melbourne, which is called the Household Expenditure Measure, which is what the banks utilise to predetermine how much money you earn, what your living circumstances are, and how much, I guess, your defined living expenses or cost of living is.
So let's get it straight. The banks are physically going to take your bank statements or ask for them, and they're going to check what you're spending on a daily, weekly, monthly basis and effectively what it costs you to live.
Definitely. So not every bank requires all your bank statements, but as a brokerage, we do need to see all your salary credits and your living expenses. So we allocate and go through. And a lot of time it's a situation where we get your income and expenses. So you tell us, yep, this is how much money I spend. We then get your bank statements. We go, there's a slight mismatch here. What was this expense? What was this expense? What was this expense? Because we can only get a snapshot, generally speaking, over 3 or 6 months. So there are, what we were talking about just before was there are, I guess, annual expenses as well that can come up, like insurance and rego, as where sometimes with some of the banks they'll just look at it as a $1,000 fee for your insurance, and they'll allocate it over 3 months, so they're only dividing it by 3 to work out your living expenses instead of the 12 months. So I guess coming and talking to somebody like myself as a broker, we can go through and actually allocate that as a 12-month expense rather than a 1 month or a 3 month or a 6 month expense, which is essentially working out, I guess, increasing your maximum borrowing capabilities.
All right, so let's get this straight. So obviously for everyone to wake up and survive, we've got some basic costs. We all need somewhere to live, whether we're currently living in a property where we're paying a mortgage, we're renting a property, okay, but we've got a cost of housing. We've all got to eat. Some of us like to drink, some more than others. No judgment here for anyone, but at the end of the day, we've all got those expenses. Now, some people smoke, some people gamble. We've all got these different things that we like to do. When we're going for a loan, what sort of expenses do banks not like?
I guess the main ones is probably gambling is the biggest flag from a bank's perspective. Because there's an addiction can come with gambling, or there's an addiction that can come with smoking, or more so alcohol. Smoking can be hidden because you can buy smokes from Woolies and so forth, but alcohol definitely clearly states from BWS or Dan Murphy's or Liquor Mart or something.
So they actually look at how much money you spend on alcohol?
Definitely, because they're all individually allocated. So like you said before, there's the household expenses, so that's just your rent or just electricity electricity and bits and pieces, but then we look at insurance, health, we look at sort of food, and then we start rolling into discretionary. So there's always an entertainment element there or aspect. So that's eating out, that's your Uber Eats and so forth. To a degree, some banks utilise gambling as entertainment. Some banks will go, no, there's an entertainment expense, and then above that is gambling. So they put that on top of whatever the defined expenses are. So that's sort of more that discretionary expenditure rather than your base cost of living.
All right, so we've all got those base costs that we need to factor in. So if we were going to get a loan and apply for a loan initially, or if we needed to refinance, in this vein of getting financially fit, let's say, for example, you did like to have a drink or you do gamble, what should you be doing in, say, that sort of period 3 to 6 months prior to applying for a loan or looking to refinance? What could people be doing with those discretionary expenses?
I guess hard to say, but ultimately the main thing is probably you're starting to reduce those to basically get ready. And it's not saying to people, hey, you're not allowed to smoke, you're not allowed to drink, you're not allowed to do anything. It's what we're saying is you may be paying, $500 a week in rent, but now you want an $800 a week mortgage. So we've got to find an extra $300 worth of surplus income. Now that can quite easily come from discretionary expenditure, or some people actually have an income threshold that's high enough that can still allow for those expenses. So there's no way we're saying, you're not allowed to do those things, but sometimes in moderation or just reducing to get that financially fit. The other thing that we see a lot of people doing, and at the moment is, again, I think we brought this up a few months ago, was debt consolidation. So whereas we recently did finance for a gentleman who had a okay sized deposit, but what the issue was, he had 2 credit cards, a personal loan and a car loan. So all of a sudden, once we allocated all those expenses, it was over $1,500 a month. Now, we did a personal loan, consolidated it all together, and now that expense is now only was $723 a month. So all of a sudden, he's now, over $750 better off per month. Which is just pure borrowing capacity because now he's not making those expenditures. So similar to reducing expenses, we can also reduce, financial commitments.
Okay, so let's get this straight. So even though this gentleman had a large deposit, and many first homeowners today, to their credit, it's not uncommon that we see people who are relatively young who can have deposits anywhere between $50, $100, and sometimes more than $100,000. So they've saved really aggressively. So they've got a good sized deposit, and sometimes they may even have up to 20% of a deposit required to buy a house. But the bank's also looking at serviceability. So yes, you've saved a big chunk of money, and that's awesome. But they're also looking at how are you going to service the debt? How are you going to make the repayments? And as part of that, they're looking at every single thing that you do in your life.
And a big thing as well is when we do get some people with fairly large deposits and have some debts, they generally, first thing everyone goes, I'm going to use my deposit and I'll pay out the debts because that'll look a lot better to the bank. Not necessarily, because in the same hand, if you did have the 20% deposit plus state fees and charges, all of a sudden you're now not paying lender's mortgage insurance, you're going to get a better interest rate. So it might be actually financially better off keeping the deposit put towards the home than it is to actually pay out the debts. So because all of a sudden you pay out your debts, you're now at 85%. Now you're paying $7,000 or $8,000 in lender's mortgage insurance, and your interest rate goes up 0.5%. It may be more cost effective to keep the car loan and the personal loan if you can afford it.
So I guess the moral of the story is talk to your preferred financial advisor. So if that's a mortgage broker like Steve or a bank, but you need to get some advice about what's going to be best for your circumstance, because at the end of the day, as Steve's rightly saying, sometimes it's better to keep the cash depending on your circumstances, because it may get you out of lender's mortgage insurance and things like that.
It may save you an initial $10,000 up front versus, by keeping the loan or doing a consolidation of loans, you might pay $8,000 in interest over the next 5 years versus $10,000 up front on your home. So, and again, with refinancing of mortgages, there are a lot more streamlined processes that are available with most of the major banks opening up what they call as a simple switch mortgage solution. So, whereas if you've come off your fixed rate into a higher repayment, so a higher interest rate, so it might be at 6.5%, you can refinance to another bank If the interest rate is lower and the repayments are lower, they call it a simple switch, where it's a very low documentation requirement to be able to just switch mortgages to try and reduce your repayments.
Okay, well, that sounds like a great feature. Now, obviously, in terms of, I guess, the whole scenario, obviously, we're a real estate podcast. So in today's market, there's been a lot of talk over the last 12 months. People thought that house prices were going to drop, and some people thought they were going to drop quite significantly. The truth of the matter, Steve, as we all know, is over the last 6 months, house prices have consistently
gone up,
risen. They're definitely not dropping, they're actually going up. So for people who are currently in the market, okay, who potentially may be feeling that mortgage stress based on the cost of living, for them, they do have options. So simple switch is one of them?
Definitely. So there is a simple switch. The other options is if you are into any sort of financial difficulty, the best thing you can do is call your bank. So we recently had a client that the wife lost a job, so she got made redundant. So they were drawn down to one income, where they got the loan based on two incomes. So they reached out to us. We sort of reached out to the bank on their behalf, and then they sort of spoken to the financial hardship team. So similar to COVID, where we saw a lot of people do repayment pauses. Banks are still offering repayment pauses if you're in any sort of financial difficulty, or they'll put you into financial hardship, where they'll just charge just interest during that period of time. So there's definitely avenues available there for most people. And once you come out of that financial difficulty, so you've got the job back and we're starting to make repayments again, if you're not happy with the interest rate or anything along those lines that you're getting with that bank, you can refinance across to other lenders at that point in time, because you've now explained to the bank essentially why there was a discrepancy. You haven't, I guess, damage your credit score too badly, because you're not missing any repayments, you're just not making those repayments. So it's a big factor that can come into consideration.
For someone who doesn't have a loan, repayment pause is probably a term that they've never heard of before. And even some people who've got a loan, they've never needed in the past, so they're not aware that there is a capacity to get something like that. So a repayment pause is effectively, you would have a monthly payment, and over a period of time, whether it be 3 months or 6 months, the bank says you don't have to make a repayment at all.
At all, no.
Okay, so that gives you potentially anywhere between 3 and 6 months. What's the normal term the bank would offer you?
I guess depending on the circumstances, most, like if it was a home loan, a lot of them would do 6 months, but most of the time they'll offer a 3 month upfront, because I guess people can sort of, if they didn't have any mortgage repayments for 3 months, they can generally get back onto their feet pretty quickly from there once they've found the job. But if you haven't found a new job and you're still sort of struggling financially, call up the bank and they'll extend it.
All right, so let's say, for example, someone had what's the standard mortgage today? What's the average mortgage in Australia?
It's about $500,000. So
we got a $500,000 loan. Okay, the repayments on that in today's climate would be roughly...
probably closer to about $3,800 a month.
$3,800 a month. So if you could get a pause of 6 months, you're going to save 20 grand plus, where you get a chance to effectively breathe.
That's it, and that's what we saw a lot of people have during COVID. So, there was mass redundancies going out. Friends of mine that worked in car dealerships, and anyone that was on probation basically got made redundant then and there. Those people could, they got a letter from their employer saying that they have been made redundant. So you call up your bank just going, yep, this is what's happened. And they've actually got departments for that specific reason of making sure that anybody that's finding it financially difficult can just reach out. So I guess that's where everyone sort of waited for all these people to go off 2% from up to 6% and go, all right, there's going to be this market crash because everyone's going to be struggling to make these repayments. But anybody that was struggling to make repayments, they just call the bank and you essentially can get some relief that way until you can get back on your feet.
Right. Okay, well, look, I guess to summarise all the things that we're saying, in this current climate where we do have increased cost of living expenses with fuel and all the things that are going on in today's society, you've got some options. So whether you're looking to get into the market, we've hopefully explained to you how you make sure you're going to be attractive as possible to the bank.
Definitely.
To either get your first initial loan, or if you're in the market already and you're an existing homeowner, okay, you've got some financial difficulties based on cost of living, there is an option there for you too. So it's not so much that you're getting fit, but you're getting an opportunity to have a break.
That's it.
Where effectively you're saying, hey, look, this is overwhelming me. I'm really, really struggling to meet these repayments. You know, you can talk to your bank about how you can get some sort of a breathing space. Okay, so hopefully that's really, really positive for the people out there. We hope that helps you. Obviously, we're very lucky to have access to Steve Beach from Stanford Financial. Thanks so much as always, mate. I'm sure the people at home are probably loving the content and the fact that, like, this is stuff that most people just don't know. So
definitely, and it's like anything, I guess, you know, everyone has mastery of their own destiny. So I guess I've done finance for over 20 years. So ultimately I live and breathe it. But if you tried to pop a hood of a car and get me to look at an engine, I'd have no clue what to do. So it's always nice to be able to reach out. And again, like I always said, everybody is just get on the phone and talk to, most brokers are more than happy to have a quick chat, you know, give some guidance and some recommendations moving forward in regards to how to get financially fit, or essentially work on pre-approvals, or what the next stages are. So we've got clients that we spoke to 12 months ago that are on repayment plans to save up enough money to be able to afford houses. Other clients that are paying down debts to get ready. So there's so many different avenues and ways where it's not just, all right, I now have a deposit, I have income, I have this, and now I'm going to go for a home loan. Reach out early and talk to your brokers, and they'll give you that advice on how long away. You know, it may be 6 weeks, 6 months before you can get a home loan, but you know, there's always an avenue available.
All right, well, awesome. Well, thank you so much again, Steve. I really, really appreciate your feedback. Once again, obviously, I hope you've enjoyed the content. If you'd like to see more of what we're talking about on the Couch with Steve, please reach out, leave a review on the link below, ask us any questions you'd like. If you'd like to see more of our content, tune in, and we'll see you on the Couch with Steve real soon.